You were just said that told that you would be you'd enjoy this presentation about the state of the market. As you're about to discover, I'm afraid enjoyment's not the adjective that springs to mind. In fact, the last couple of times I've done these, I've only been done 5 state of the market, the quarterly reports, and the last couple of times I've done it, I've been I think called Dr. Death, because the message, I'm afraid, is not over enthusiastic. That's 2 weeks ago we were bought by SNL, so all of a sudden I have these copyright notices. But broadly speaking, that's what I'm going to go through today. Quick overview of the prices and market conditions, and I don't pretend to be an expert on these. I'm, you've just been told, 27 years at Mining Journal, so I'm a cut and paste expert as much as anything. The hard yards I'm going to go through in this presentation are done by the database itself. And in fact, because these numbers are for the quarter to the end of December, these are hot off the press. I only finished going through all the numbers about 24 hours ago, so you might see some typos in this lot. Anyway, having gone through some of the prices and market conditions, most of which you'll be familiar with, I'll go through what the numbers are telling us for the quarter to the end of December, both the quarter and the year. As you'll see, there's still not a very good picture, I'm afraid. And then a quick focus on Africa with Indaba coming up. And unfortunately, those numbers, most of them are based on a report I did in the middle of last year, but the trend was based on a 2-year analysis of numbers, so I think they still hold true. Start with a couple of slides that you most certainly will be familiar with. I've put these on the same scale as is my want, or at least ways gold is on the same scale as a couple of commodities there, so it doesn't look quite as grim as it really is. But you can see from the red dotted line there when things started turning pear-shaped. I actually joined Intiera at the beginning of 2012, just when things were sliding nicely. And fortunately, I'm still in a job, but it's been depressing every quarter talking about what's going on. Similar picture for some of the other commodities. Again, everything started sliding, obviously, in the middle of 2011, and you'd be aware, obviously, that the financial depression, recession had been going for a few years by then. Metal prices, you can see from the left-hand side of that graph, carried on remarkably well for the few years after the onset of the financial depression. It's only now that it started catching up. That's just looking, again, before we get onto the details that probably will be new to you, some of the recent picture, 15-month picture for most commodities. Truly dreadful for most of that time. Coal's picking up now. Iron ore's more or less flat trending. Gold, as you'll be aware, has didn't have a great 2013. Those are the recent trends, but with deference to Philip Crowson, for those of you who don't know Professor Philip Crowson, he was the chief economist at Rio Tinto for a long time and director of the LME. Does some spectacular books that were published by Mining Journal. Well worth buying if you're interested in mineral economics, but he does everything in real prices and he goes back a couple of 100 years more often than not. And he's a great advocate of you can't tell from trends, historical trends, and you can't project into the future. And as he pointed out, there was a 35-year trend upwards starting just before the Second World War. I joined the mining industry in mid-1970s, well, late 1970s rather. Worked on the gold mines in 1980, and of course you can see from the spike in on the gold prices a similar spike. Everyone thought the industry would carry on that trend. About 1970, the industry started turning down. Gold turned down in 1980, and then we had a 35-year trend the other way. For those of you who can remember, about the turn of the century, everyone was doom and gloom and predicting prices going down forever. And then all hell broke loose, and that graph's a couple of years old, but obviously sudden jump up. The problem with all these things, as Philip Crowson will have pointed out, where do you start? You can prove anything you like if you start at a certain point. So a couple of years ago, in fact, when I was still with Mining Journal, I thought we'd go back to the beginning, go back as far as you possibly can with gold, and thanks to the Bank of England, you can go back to 1270. And if you plot gold from 1270, is the World Gold Council here? I usually get hate mail after this slide is shown. Francis Drake was sinking Spanish galleons at less than 1,000 sterling an ounce. I see no reason why gold should be more than £1,000 an ounce. And, well, if you're aware, a couple of years ago, gold went through £1,000 an ounce. It's never been remotely close to that, or at least when it touched it in the 1500, about the time the US was discovered. It didn't last long there. Gold is tracking back, and quite right too, on a 500-year cycle. As I said, I know 2/3 and not a lot on what the metal prices are going to do. All I do is draw from what Philip Crowson has graphed, and as I say, if you're interested in these, he explains it all in his books. But basically, consumption follows global GDP, and that's intuitive, but he proves it in the graphs, and I think if you look at that graph, it's pretty impressive fit. These are percentage changes year on year, global GDP against metals consumption. And it's an even better fit if you take OECD output and plot it against metal prices. Now, grant you that's a basket of prices, and I hate grouping prices. As our copper analyst would tell you, you can't really add copper and aluminium and everything else and come up with a sensible number. But if you did do a basket of commodities, it's an exact fit with OECD output. I'll just point out that it says 6 times volatility, so the metal prices are plotted against the right-hand graph, and the OECD output is against the left-hand percentage change. But even so, that's, with a couple of exceptions, as good a graph fit as you're likely to see. So in terms of predicting metal prices, just predict OECD output. With that in mind, our consulting division in Stockholm, the Raw Materials Group, every year they look at ore production, and whilst the metal prices give you one picture, ore production every year has increased, well, for about 40 years. And you can see the plot there, and they see no reason why it should change. When metal prices were going higher, we were producing more ore because the grade was lower, and they actually think, although metal prices have come back, the same ore trend is going to continue, which of course, if you're in the business of selling trucks and the like, this is the important bit. Metal prices themselves don't matter that much to the mining industry. It's how much ore is going to be produced for the equipment guys, I should say. They do a similar thing with CapEx. Obviously, if the ore production's carrying on going up, all things being equal, you expect capital expenditure to carry on going up, and that's been the picture in the last few years, metal prices notwithstanding. They think it has dipped in the year just ended, and we'll know fairly shortly. It looks as if they're right. They think it's going to go down a lot in this current year because a lot of projects are being suspended or they're reducing the capital expenditure. But then it'll pick up again as the normal factors come back into play. Right, now turning on to some of the numbers, these ones now straight from our database. Intiera Live and my new masters, SNL, so the Metals Economics Group, basically do exactly the same thing. They skim all the stock exchange press releases, so all this stuff is automated that you're going to see from now on. So the good thing of that is it's what's been published. There's nothing added or taken away. The bad thing, if there is one, is that there aren't many private companies in there, and there aren't many state companies in there. We put them in when we can, but obviously they don't tend to put out the same level of press releases. So what you're seeing is the listed companies in the world, by and large. We reckon there's nearly 3,500 listed mining companies, and if you aggregate them all, that's the market cap at the end of December of the mining industry. Somewhat surprisingly, it was up 6% on the September quarter. It's good, you might think, but of course it's come from a really diabolically low level. So as you'll see in a minute, there is some optimism. We do appear to have hit the bottom and coming back up. But that's the total. I can bore you afterwards with some of the details, but 2,000 of those 3,500 companies have a market cap of less than 10 million. And those companies have got an average market cap now of 2.5, well, nearly 3 million. And as you'll see later on, they've got cash holdings on average of less than $1 million. Over half the mining industry is in a serious mess at the moment. As you see in a second, exploration is declining, financing for exploration is almost at a stop, and their cash is running out. So although the whole industry's improved and doesn't look too bad, there are 2,000 companies, a lot of them in Vancouver and Perth, that are in a serious mess at the moment. And that's reflected in that graph. That's to the end of December, monthly plots. And I should just explain, this isn't actually drilling in that month, it's announcements in that month. And there's a slight difference, obviously, but we can only take what's announced. So there will be a slight lag, but the trend is pretty clear. It started at the end of 2011. There were a few blips where it looked as if things were improving. I should have known better, but in the middle of last year, the quarterly state of the market for the end of the June quarter, when things just improved, I famously put in a comment that there was a light at the end of the tunnel. And of course it was the proverbial locomotive coming the other way, because straight after that we had one of the worst quarters the industry has ever seen in terms of exploration drilling. These are prospects, incidentally, the number of individual prospects reporting drilling. So it's not perfect, it's not meters drilled, because mining companies don't report all their drill holes, they'll just give you a snapshot. So the best facsimile we've got of the industry, unfortunately, is just how many people are reporting. We also get, as you'll see later, how much they're spending, but we don't actually have how many meters they're drilling yet. But most of the problem has come in gold. It's the yellow bars there, you can probably make it out. If you're interested subsequently, I can give you the actual numbers, but gold is the main casualty in the last couple of years, as you can imagine from the gold price. No great surprises. That's where the drilling announcements came in the last quarter. Obviously down the western seaboard of the Americas, southern Africa and western Africa, and a great splodge in Australia and Canada, of course. I always counsel a bit against worrying too much about the individual numbers because, as I say, these are announcements, and some people will announce quickly, some will announce slowly, and we're still waiting for the production figures for the last quarter because people tend to be a bit slow in putting them out. But these are prospects announcing drilling activity. And I've just circled the totals because that's more reliable than the individual numbers, but you can see there that the gold drilling is about less than a half what it was a year ago, and down on the September quarter, which was pretty diabolical. Silver similarly, about a half of what it was a year ago, and do remember that a year ago was bad. And I keep saying every quarter it can't get much worse than this, and I stand by that. I don't see these numbers getting much harder, but I said exactly the same thing a quarter ago. Zinc, not dissimilar, it's more or less held steady against the September quarter, so sort of 40 prospects are still drilling for zinc. But on the plus side, despite the copper price not doing a huge amount, they are doing more drilling for copper at the moment. But again, it's still down on a year ago, but at least it's improved on the previous quarter. If you plot these, the new development projects by the location, you can see there's, as I've circled, it's pretty difficult in most places. The right-hand bars of each quarter are the bars show the regions of each quarter, and you can see there is signs of hope in that last quarter in North America and Africa, compared with the previous quarters. Similarly, if you take all the development projects and work out the life of mine capex as announced by the companies, and all this is done in macros in the database rather than me sitting on an Excel spreadsheet, I hasten to add. Although the African projects, there's quite a number of them in the last quarter, as the previous slide showed, they're small. So in terms of the world view, the African projects hardly make a dent on the world capital expenditure. Most of the increased capital expenditure in the last quarter has come from North and South America, as you can see, fairly significant jumps from the previous quarter. Same thing for net present value. The problem with the net present value is, again, I stress that this is what the companies announce. We don't do these at the moment. I think this is going to change with SNL having bought us, because they've got a banking database as well. But the moment we take the net present value as declared by the mining companies and the consultancy groups, so they might well be using different discount rates and certainly be using different gold prices and the like. But having said all that, as published, the South American projects have a very poor net present value, even though there's quite a lot of capital expenditure going on and quite a number of projects. It's again North America that are leading the way, and Africa has had an appreciable increase in net present value in the last quarter. Again, now this is new reserve announcements. Last time I presented these numbers, I think somebody got the electronic copy and didn't have the verbal description that went with it, and they thought these numbers were totals. And I got told off that South Africa had a lot more gold resources and reserves than I'm showing on here, which of course is true. I worked on the gold mines in South Africa. I'm well aware of the gold resources in South Africa, and the problem with the gold in South Africa, for those of you that aren't aware of it, is they tend only to drill ahead what is necessary for the next 2 years' development. Unlike most other jurisdictions, they tend not to drill too much more than they need to actually to work into the future. So declared reserves and resources on the South African gold mines are invariably look unappealing. But these numbers are what was announced in the last quarter, or compared with the previous quarter and the year ago. So these are the new projects, the feasibility studies, where the likes of SRK have announced resources and reserves. If we just look at the left-hand side, so the resources, you'll see that again, the picture's pretty dire. 35 million ounces of gold were declared as a resource in the last quarter, and that compares with very nearly 255 million ounces a year ago. And that's the scale of the problem in terms of what's coming through to the industry. The number of resources announced, and it's a similar story on reserves, has simply collapsed. Even worse for copper, although as I've said earlier, they're now actually at least started drilling again. But copper, I mean, it's hardly worth putting down. 5 million tonnes of contained copper in ore in the last quarter, compared with 93 million tonnes in ore a year ago. And again, a year ago was not great. Similarly for silver and zinc, zinc is more important. Essentially, zinc stopped. To all intents and purposes, there were no zinc resources announced in the last quarter, compared with 22 million tonnes of zinc contained in resources a year ago. A slightly brighter picture if you look at the total pipeline. Now this is not just what was announced in the last quarter, it's what's in total in the industry. And now again, there are some problems with this in that we're not always told when companies stop projects. We're always told when companies start projects. And my colleagues, the erstwhile colleagues from Mining Journal here will tell you this. You get any number of press releases that are good news. You get all the drilling results from Good News and new mines and everything else. You tend not to get press releases from people saying they've stopped a project. Anyway, given that caveat, this is the number of projects, the yellowy line, after a quarter of decline, a year of decline in 2012, it picked up again towards the last year. And so by the end of last year, we had just over 1,300 projects in the mining pipeline. And somewhat surprisingly, for the last few years throughout the recession, the committed capex for these projects has carried on to climb. Some of these might have actually been suspended, but has documented the amount of capex the industry has said it's going to spend has carried on rising, although it's flattening off. And Raw Materials Group think it's actually going to start falling now for a couple of years because of the ongoing problems of projects being suspended. I won't bore you with all of that. We obviously do a plot for all the metals, but these are the three ones that dominate. Somewhat confusingly, I've put them on two different scales, so I thought it'd be helpful and put the numbers in as well. But you can see there that gold, because it's plotted on the right-hand scale, actually dominates far more than might appear on that graph. It's 431 gold projects in the pipeline. There's 230 copper projects and 208 iron projects. But generally speaking, they're holding up reasonably well, and gold is actually continuing increasing despite the gold price. If you look at CapEx, it's a slightly different picture, and not surprisingly, because obviously the iron ore mines tend to be larger projects. So when you look at CapEx rather than just purely the numbers, iron ore and copper dominate in terms of CapEx. And that's the plot. And again, it's still increasing when you look at the total pipeline. The problem, if there is a problem, although the totals look very nice, and the feasibility studies actually increased in the last quarter, and there's now 313 feasibility studies we've got on the database. The problem is appearing on the conceptual and pre-feasibility, the early stage projects. Although they're not appearing to do too badly in this plot, and there's 232 conceptual ones, these numbers are historically very low. Because conceptual projects you'd expect to be quite a lot bigger than feasibility studies, because if it's a concept, they won't all make it to the feasibility stage. We've got a problem building here because there aren't enough mines coming through, the projects coming through the pipeline to feed these feasibility studies. You'd expect that to be about 2 or 3 times as high. So I would guess in 2 or 3 years there's going to be quite a demand for good projects that are at the feasibility stage. You'd expect those prices, takeover prices, to start rising. Similar thing for CapEx. There's about $67 billion of projects in construction at the moment, and 241 projected CapEx in the feasibility studies as of the end of last year. And those are the recent plots. You put it all together, it's not a terribly clear slide. I apologise, these slides are done for the report, which is coming out in about a week's time. So they're designed for a report, and they look a lot better on the page, I have to say, than they do on a slide. Deals have increased. We're looking at mergers and acquisitions now. So bearing in mind everything that's gone before, it's perhaps surprising the number of deals have increased. But the actual value for each deal has fallen quite sharply in the last half year. And so the actual value of mergers and acquisitions has carried on trending down. And I think we're now at an all-time low, at least as I can't see a number lower than that one. So those of you in the banking side of things, that's the reason everything's been depressed, is M&A activity in the last quarter, as you'll see from the subsequent slides, is pretty poor. Just to demonstrate why you shouldn't rely on statistics too much, phosphate led the way in the last quarter, 35% of the total, almost entirely because of one project, one deal. So it's usually better to look at the trends over a longer term, but if we were to just look at the picture in the last quarter, that's the breakdown. Similarly there, that's just doing it as in a tabular form. Phosphate, that was one deal. So that one deal pushed the US to the top acquirer country in the last quarter, and phosphate to the top commodity. Ordinarily, of course, it's gold and copper are towards the top. But anyway, 4 billion essentially in the last quarter in terms of deals. That's just taking the three normal main commodities. I've stripped out phosphate, but that shows the trend the last year for the three metals. And that first quarter again is skewed by one particularly large transaction. If you take that out, it's not so different all year. But after the Polyus transaction, M&A went into hibernation last year, as you can see from those numbers, for all three commodities. Not all too depressed yet. We take that then, the pie chart for the whole year. You get a slightly better, more balanced view of the industry. Again, obviously, it's still skewed by those extremely large transactions, but that's a more normal breakdown of M&A activity by commodity. You'll be familiar with most of these, but those are just the largest mining deals that we plotted. I think there's a lot to add on that. That's a similar table to the one before, but this time it's for the whole year. And again, it's a bit hard to see because I've tried to cram everything into one page, but the top acquirer country last year was Russia, but that's I think a third of that or something like was for the one deal. Gold accounts, as you can see there, for 8.7 billion out of the 26 billion total in the transactions last year. We recorded 227 announced transactions. Now, this is the funds raised to finance both the capital expenditure and, of course, the mergers and acquisitions and the like. This shows not only the funds raised by size of company, primary exchange and company type. This is a fairly loose description. But it also shows cash holdings. And the cash holdings, I'm afraid, are always a quarter in arrears. So these are the numbers for the end of September. As I said earlier, all that's demonstrating there is how the top 2,000 mines in the world, the top 2,000 companies in the world have an average of well short of $1 million in the bank. You can see where most of the money, not surprisingly, was ranged at the big end of town. Those are the totals there. 5.2 billion of the 6.2 billion came from companies with a market cap of over 100 million. And the TSX had a spectacular quarter. Compared with the previous quarter, certainly, and that's they issued 4.3 billion of the 6.2 total. London had another quiet quarter, but at least it's an increase on the pretty shocking September quarter. This is the problem area. It's capital raising for exploration. See, most of the capital raising for exploration has come from the Vancouver and Australia. Toronto's kicked in a fair amount. London has hardly surpassed itself in the past year, or the past 5 quarters. But you can see, I mean, not only was TSX Venture Exchange and the ASX considerably larger in terms of exploration funding than anywhere else, they also improved in the last quarter. And this is where there is some room for optimism. The Canadians and the Australians seem to have started to find an appetite for exploration, albeit from a fairly low level again. This is actually by the target, where the exploration is targeted to. So there's a fairly big sector there that's unspecified because we're not always told when people are raising finance where they're spending it. But if you take where they've said they're going to spend it, there was quite a significant increase in Australasia, essentially Australia, in the last quarter. Despite the doom and gloom coming out of Australia and the considerable political issues they've got over some of the tax burdens, they are starting to spend again on raising capital for exploration by the looks of it. That's roughly the picture globally, and I thought with Indaba coming up, I'd just have a quick look at the situation in Africa. Now, this comes from a similar report I did, published in June, and so the numbers are, by the nature of that, half year old, but I think the trends are fairly self-explanatory. This is a very similar graph to the one I did earlier, but it's just for Africa. And the noticeable thing, if you can recall the previous graph, the world drilling started down about a year earlier than it started down in Africa. Africa, not quite sure why, carried on drilling at a high level for another year compared to the rest of the world, but then hit the buffers towards the middle of 2012 and has come down extremely sharply since. And again, its gold has taken a fair chunk, as you can see there. Gold has taken a fair chunk of the damage. Everything has been impacted, but you can see gold was accounting for a good percentage of the drilling prospects announcing in the end of 2011, and the taps suddenly turned off. Incidentally, the extended plot, it has improved from that, but it's not dramatically so. Where are they drilling? Usual suspects, Southern Africa overwhelmingly, and of course West Africa. The size of the bubble, incidentally, relates to the type of drilling. I don't think these numbers are terribly significant, except to say that the last 2 years activity was, 2011 and 2012, the activity was fairly similar in the different countries. For iron ore, there was a noticeable increase in the number of properties announcing iron ore exploration drilling. That's where the gold greenfield resources were announced in 2012. And it's a similar story last year as well, once I can get around to plotting it. But the fair amount in South Africa, and of course the main boom was in West Africa in greenfield gold resources, this plot. If you actually plot it then against additional gold resources, and again I stress this isn't total gold resources, this is the additional gold resources announced in those 2 years, and I put little lines in to show where the big changes have occurred. But noticeable, I think, was a massive increase in Guinea, and an incredible drop. It was about a quarter what it was a year before in South Africa. And the other thing just to note are the red percentages at the bottom. That's the percentage of of Africa's contribution to the world. That bottom number is the rest of the world, so the world total is the sum of the two. So Africa contributed 14% of the world's new gold resources in 2012 from 23% the year before, and that percentage has come down again in 2013. If you look at copper, it's a similar story for Africa. It's contributed about half what it did the previous year. A lot of that's due to a collapse in new copper resources coming out of South Africa. Broadly speaking, stopped. And a similar collapse actually in the Congo. There's a lot of activity in 2011 in the DRC and came back quite a lot in 2012. Coal. Africa is a massive contributor to in situ raw coal announced resources in 2011. There's going on for 30% of the total. And again, just stopped basically. So in 2012, partly because of a big drop back in Mozambique, but also again, South Africa was about a third, well, going on for a third of what it was the previous year. If you take a 10-year plot, which is probably the more valuable, it does actually show that despite those apparently depressing figures, Africa still leads the world in terms of gold resources uncovered over a 10-year period. As you saw from those numbers, it has not impressed in the last couple of years, but if you take a 10-year period, you can see comfortably ahead of North America in terms of new gold, and its grades are some of the highest in the world. If you look at financing for exploration in Africa, I'm not sure that pie chart tells you a huge amount, except that over 40% was for West Africa. Not surprising because of the amount of activity there. And to try and get a better, to smooth out some of the irregularities, we did this over a 2-year period. So these percentages are for the 2 years to the middle of last year. So 829 million was raised for exploration in Africa over a 2-year period. That's how it breaks out and how it was spent over that period. 56% to gold. And the impressive thing there is not just is it 56% of the total is for exploration in Africa over that period, but there are 61 companies exploring for gold in Africa, compared with these significantly lower numbers for all the other metals. So, despite the travails of the gold price, there's still it's the sexy metal for a lot of companies. If you plot the same sort of thing in a different way, I don't know if it makes it clearer, but it breaks it out by quarter for the last few years, or 2 years. And again, you see there was a particular spike at the end of 2012 for gold and platinum group metals, but apart from that, it's been fairly flat-lying for the last couple of years in Africa. If you did it by exchange, and this is where the companies are raise the finance. And what's interesting there, I think, is that particular period where there was a lot of finance for African exploration. It was led by Toronto and London, dominate the exploration scene in Africa. But apart from that period, it was fairly lackluster. If you do it by objective, and this is somewhat problematic because not everyone tells us how they're going to spend their financing. And this is by exploration companies and what they were going to do it on. The interesting thing, I think, is and that 2013 is only for half the year. But in terms of the percentages, big fall off in development. So a lot of the money that was raised by the companies wasn't for development, it was actually for debt rollover and other capital expenditure on other forms rather than the development. That's where it was spent. The bigger the bubble, the bigger the amount earmarked for development. I don't think there's any great surprises there. There's the West Africa, Southern Africa, and then the other major mining areas. I've only got one example of drilling down further to look at the individual projects, but just as an example, that's how we would plot these things out. So that's development spending in Southern Africa, and again, the bigger the bubble, the larger the amount earmarked, and the different colours tell you at what stage that money is earmarked for. Quite fun to rank revenue in Africa. I apologise again, this is only 2012, but I don't suppose it's dramatically different. But if you look at the earnings, production earnings from the mines in Africa, there's two that dominate, more or less 20% each, gold and coal, and it drops off fairly quickly after that. But basically 120 billion earned by mining companies in Africa in 2012. I've spoken a bit about the problems South Africa has, but I don't wish to belittle the country. It accounts for 54% of Africa's mined revenue. So whilst they're having a difficult time at the minute and most of the numbers are heading down for South Africa, you can't plot them on the same graph. So they went shooting off the top. If you did plot them on the one graph, I did it as an insert there, it makes a nonsense of a graph. So that's the graph for the rest of Africa, and the next biggest is 6% with Zambia. So it goes from 54 in first place to 6 in second place. So for those of you going into Indaba, yes, South Africa is what it's all about in Africa still. If you do it by primary exchange where those companies are listed, not surprisingly, the Johannesburg Stock Exchange is the most important. But as you saw from the previous slide, they don't raise much money there. So they might be listed in JSE, but they actually go somewhere else to get the money. Second place in terms of primary listing, not surprisingly, is London. It's still thought of very much as the backyard for investing in Africa, and a huge tail there of small stock exchanges. We also separate it by the type of revenue, whether it's from an open pit or underground, and so you can see the breakdown of a large percentage. The different exchanges tend to focus on different sorts of mining, so the private and state companies are overwhelmingly into open pit mines. Different story for JSE. A lot of the listed companies on the JSE actually get their mined revenue from underground operations. That's if you map it. If you're next in a pub quiz and you want to know what the biggest mine in Africa is, you'd probably win $1 or $2 by saying it's a phosphate mine. I have to say, until I did all the numbers, I'd assumed it was a gold mine somewhere, or an iron ore mine, or a copper mine. No, it's a phosphate mine in Morocco, comfortably the biggest mine in Africa. And in fact, the next biggest, as you see there, is heavy media sands. Anyway, I think this graph, what it does is show that if you plot things by revenue of production, it's Southern Africa and West Africa, overwhelmingly. Again, I've only got one example of mined revenue, just as to illustrate it. This time I've chosen West Africa, and those are the plot of the biggest revenue earners in West Africa. We can obviously basically put in infrastructure and measure how far these mines are from the railways and things for those of you interested in infrastructure type developments. Production trends. Again, this is Africa. And again, notwithstanding the fact that South Africa is the dominant gold producer still, it is trending down. I was on the gold mines from 79 to 82, and it was then come to the biggest gold producer in the world, of course, and I think it's the 5th biggest. And that's why that will continue trending down. There's little questioning of that. And the other, you can see, most of the other producers have stayed more or less flat in the last few years. If you look at copper, again, South Africa, it's not terribly obvious, but trending down slightly. But Zambia and the Congo have done very well over the last few years in terms of their production. Head and shoulders the biggest copper producers on the continent, and actually improving. Now if we look at the top mines, this is not a particularly elegant ranking, it's just in terms of production rather than revenue or profit. But in terms of production of the metal, those are the biggest 10 gold mines, and you see 3 are in South Africa. You take the continent's 10 largest copper mines, obviously Zambia and the DRC feature, and South Africa's got 1. Clean sweep of coal mines. Essentially, there's not a lot of coal on the continent, and a couple of exceptions, but broadly speaking, all the significant mines are in South Africa. And ditto, really, iron ore. 6 of the top 10 iron ore mines are in South Africa, and that helps explain the revenue numbers. And that's it. Thank you very much.